Welcome to the deep dive. Today we're looking at Bharti Hexacom Ltd. They're a pretty key player in Indian telecom, and their Q1 FY26 results just landed. Some really impressive growth numbers in there.
That's right. These are the audited results for the quarter ending June 30, 2025. And just as a quick reminder for everyone, Bharti Hexacom provides communication solutions. Think mobile, fixed line, broadband.
Yeah, primarily in Rajasthan and the Northeast telecom circles in India.
Exactly. All under the Airtel brand, which most people will recognize.
So our goal today is, well, to give you a clear, pretty concise understanding of what's driving these results. We'll look at the company's operational health, its strategic moves.
Yep, basically help you get quickly up to speed on this important market player.
Okay, let's dive in. The big financial picture first. Revenue and profitability, they seem to really surge.
They did. So total revenues hit Rs 2,263 crore for the quarter, which is an 18.4% increase compared to the same quarter last year. So yeah, strong top-line growth.
And the profit story, net income.
Right. So net income before exceptional items. And that before is important. It more than doubled year on year.
Doubled, wow.
Yeah. Reached Rs 392 crore. That's up from Rs 193 crore last year. A huge 102.9% increase.
Okay, so why the emphasis on before exceptional items?
Well, you see, exceptional items are usually one-off things. Last year, the after exceptional items number looked higher, but it included a significant positive one-off. So focusing on the before figure gives you a kind of truer picture of their actual operational performance day to day.
Got it. That makes sense. It strips out the noise. What about profitability margins then?
Also very strong. EBITDA came in at Rs 1,217 crore. That's up 33.5% year on year. And the EBITDA margin itself improved significantly. It's now 53.8%.
53.8%. Wow, that's up from what, about 47.7% last year?
Exactly. That's a jump of 606 basis points, over 6 full percentage points. It's quite something.
I remember hearing about their War on Waste program. Is that feeding into these margin gains, do you think?
Oh, absolutely. I mean, the war on waste reflects a real focus on operational efficiency, cutting non-essential costs, streamlining how they do things.
Right.
And you can definitely see that discipline paying off in these numbers. It doesn't stop there either. EBIT earnings before interest and taxes, that was Rs 677 crore.
Okay.
Up a very sharp 62.8% year on year. And the EBIT margin, that climbed to 29.9%.
Almost 30%.
Yeah, up 816 basis points from 21.8% last year. So it really shows strong operational leverage, good cost control.
Okay, let's unpack this a bit. How did these impressive numbers actually come about? What were the specific engines driving things, maybe looking segment by segment?
Good question. Because the drivers are, well, quite distinct for each segment. Let's start with mobile services.
Okay.
Revenue there grew by 17.8% year on year. A big part of that was what they call tariff repair.
Tariff repair sounds like price adjustments.
It is, but it's a bit more strategic than just hiking prices. It's about resegmenting the market, maybe focusing more on plans with value-added services that justify a higher price point.
Right, smart in a competitive market like India.
Exactly. And alongside that, they had strong additions of smartphone data customers and just generally an improvement in their portfolio mix.
You can really see that hitting the ARPU, right? The average revenue per user.
Absolutely. ARPU jumped significantly. It's now Rs 246 for the quarter.
Up from Rs 205 last year.
Yep, a 20.2% year-on-year increase. That's a key metric.
And customer growth. Still adding users.
They are. Smartphone data customers were up 1.6 million over the year and 0.3 million just in the quarter.
Okay.
These users now make up 77% of their total mobile base, which is 28.146 million customers overall.
And people are using more data, I assume.
Oh, yeah. Mobile data consumption grew 23.8% year on year. The average customer is now using about 29.4 gigabase per month.
Wow.
And to handle that, they've been busy. Deployed 518 new towers in the last 12 months to boost coverage.
Okay, so that's the mobile side. What about the homes and office business? Fixed line, broadband?
That segment also showed really strong momentum. Revenue was up 38.0% year on year.
38%? That's huge growth.
It really is, driven by strong customer acquisition and also expanding their footprint, both in new cities and deeper into existing ones.
How many customers did they add?
They added 54,000 net customers just in Q1. That brings their total base to 502,000.
500,000. And how are they rolling this out so fast?
They're using what they call an asset-light partnership model. Basically, they team up with local cable operators, LCOs, to speed up the rollouts.
Ah, clever. Leverage existing infrastructure.
Exactly. And it seems to be working. They're now operating in 115 cities.
Now, I did notice the EBITDA margin for homes and office dipped slightly, down 1.5 percentage points to 31.8%.
That's right, a slight decrease.
And the operating free cash flow for just that segment was negative about minus $775 million. That seems to contrast with the overall picture.
It does, and the reason is a big jump in CapEx specifically for that homes and office segment.
Oh, okay.
CapEx there was Rs. $1,024 million compared to just Rs. $337 million last year. That's a 204% increase.
So they're investing heavily there. What does that tell us? Investing aggressively, even if it hits short-term cash flow for that division.
It tells us they're playing the long game. That negative free cash flow isn't necessarily bad. It's a sign of deliberate, aggressive investment. They want to grab market share in broadband, which is a high-growth area.
Right.
So they're prioritizing getting customers, building out the network. They understand these upfront costs are needed to build something substantial that will pay off later.
It makes a lot of sense. Okay, beyond the core numbers and the segment performance, here's where it gets really interesting, I think. Seeing how they're innovating beyond just, basic pipes.
Yeah, they've made some pretty smart strategic moves recently.
Like the Google One partnership.
Exactly. Offering 100 gigabytes of Google One cloud storage. It's free for 6 months for their postpaid and Wi-Fi customers.
And shareable too, right?
Yeah, with up to 5 people. It's a neat way to tackle the storage headache lots of people have, and it makes their service stickier.
Right. Solves a real problem. And after the 6 months,
it's Rs. $125 a month. Activated through the Airtel Thanks app. Pretty straightforward.
Okay, that's clever. And they also upgraded their spam detection tool. That feels very necessary.
Totally. They added 2 big things. First, language alerts. It now works in 9 Indian languages: Hindi, Marathi, Bengali, Tamil, and others.
That's huge for India.
It really is. And second, it now alerts you to international spam calls. Apparently, those have jumped about 12% recently.
Wow. Didn't know that. And this is free.
Free, auto-activated, currently on Android. Again, it's about tackling those everyday annoyances that can make customers switch.
Definitely. It's not just about speed anymore. What else? Weren't there new entertainment packs?
Yes, new all-in-one OTT entertainment packs for prepaid users.
OTT, so streaming services.
Exactly.
Right.
Access to over 25 platforms, Netflix, Geo Hotstar, Z5, Sony Live, you name it, starts at Rs. $279 for a month.
Okay. Bundling content with connectivity.
Precisely. And they have bundled plans too, starting at Rs. $598, which include these OTT packs plus unlimited 5G data and calls. It's about becoming that single hub for entertainment and communication.
Makes sense. And one more thing on the strategic front spectrum.
Right. They signed a deal with Adani Data Networks.
Oh, interesting.
To acquire rights for 50 megahertz of spectrum in the 26 gigahertz band, specifically in Rajasthan. It still needs regulatory approval, of course.
Standard procedure.
Yeah, but it shows they're thinking ahead, securing capacity for the future for next-gen services.
So all these strategic moves combined with the operational performance, if we connect this to the bigger picture, that financial efficiency you mentioned earlier seems really key.
It really is. Let's look quickly at their overall financial health debt capital allocation.
Okay, CapEx first, capital expenditure.
For the quarter, it was Rs. 2,270 crore. Now, that's actually down 29% year on year.
Down, while growing revenues like that. That's quite disciplined.
Very disciplined. And that lower CapEx, combined with the strong EBITDA we talked about,
leads to good cash flow.
Fantastic operating free cash flow. Rs. 9,902 crore. That's up a massive 67% year on year.
Wow. That's a really strong signal, growing fast and managing cash flow effectively.
Exactly. And the strong cash flow lets them tackle their debt.
Right. The debt position, how's that looking?
Much healthier. Net debt, including their lease obligations, is down significantly. It's now Rs. 63,160 crore.
Down from over 75,000 crore last year.
Yep. Down 16% year on year. And this dramatically improves their leverage ratios.
Okay, talk me through those. Net debt to EBITDA.
On an annualized basis, that ratio is now 1.30 times. Compare that to 2.07 times just a year ago.
So much more comfortable. Less debt relative to their earnings.
Much more. Gives them more financial stability, more flexibility.
And there was another ratio mentioned, excluding lease obligations.
Right. Net debt excluding lease obligations relative to EBITDA, that's EBITDA adjusted for lease costs, that ratio is down to 0.65 times.
0.65. That's really low.
It is. Down from 1.29 times last year. It gives an even clearer view of their core debt versus their cash generation. Plus, shareholders' equity is up too.
So the balance sheet is looking much stronger overall.
Definitely. It fits with what the company says about, consistently optimizing their capital structure, allocating resources judiciously. It strengthens the balance sheet and frees up capital.
Okay, so to wrap things up briefly, Bharti Hexacom delivered a really robust first quarter,
Yeah, driven by strong growth in both mobile and home services.
fueled by some smart strategic innovations like those partnerships and bundles.
And importantly, underpinned by a much healthier balance sheet, significantly lower debt.
This deep dive should really give you a clear sense of their momentum, wouldn't you say, and their strategic direction.
Absolutely. Improving the user experience, expanding the network, managing finances, well, it's all coming together for them, setting them up nicely.
So maybe a final thought to leave everyone with. How does Bharti Hexacom's specific regional focus, Rajasthan and the Northeast, combined with these innovative bundles and network expansion, how might that position them uniquely against the big national players in India?
That's a great question. What does their success in these specific areas, these specific services, tell us about the future? About connectivity, about content, especially in diverse markets?
Could that regional strength, that focused approach, actually be a blueprint for others? Something to think about.